Saturday, October 31st, 2020, Maneco 64, home of alternative economics and contrarian views. Today we're going to look at why I think unless the Federal Reserve prints or creates a few more trillions of reserves in the next month or two, I think the financial system will be in big trouble or deep trouble like it was back in February and March this year. And why do I say that? Is it hyperbole? No. And I highly recommend you watch one of my videos from August this year. It's entitled, Why Bonds Are So Important to the Everything Bubble. It's a long video, but I go through all the details of why the bond market, especially the Treasury market, which is considered the risk-free rate of return market, is so important, not only for other bonds, lower rated bonds like corporate bonds or even loans or derivatives. That's another great subject, of course. Derivatives, the biggest part of the derivatives market, of course, is in the interest rate or bond market, but it will also affect all the other markets like the stock market, commodities, and highly recommend that. I'm going to put it up in the cards and below in the description. And also more recently, on the 21st of October, I made a video entitled Dollar Falls to 28-month Low versus U1 as 10-year yield spikes. So I was starting to see troubles already in the bond market, in the Treasury market. So yes, I have a feeling it's not just the politics and everything that's happening geopolitically around the world, but it's also the finances, the deficit spending, and the financial system is hooked on easy money. And unless the Fed comes to the rescue very soon, I think we could start seeing not only higher yields, but high volatility. And volatility is what is basically the Achilles heel of the whole financial system, mainly because it's such a leveraged system, the financial system, through probably over $2 quadrillion of derivatives, and the bulk of those derivatives being based on interest rates. So I think the Fed has to come to the rescue very soon. It probably will do so after the elections next week. That's how I view it. So now I want to go through a couple of articles from the mainstream, because it shows that it's not just me here trying to warn people, but also the mainstream. We're going to look at an FT article. You can't go more mainstream than that for the financial system. And we're going to look at the Wall Street Journal, one of its articles. They're both talking about treasuries. So FT says, Treasury sell-off reignites question, how high can yields go? Bets on big move higher in long-term bond yields could be misguided, managers say. So there's still quite a bit of complacency out there. I think a lot of fund managers and big investors expect the Fed to come in and rescue them again. And that's why I think the Fed will have to increase its QE even more. It's kind of stabilized in the last few months around 7 trillion. It's just over 7 trillion, the assets on their balance sheet. We know it's come from around 3.5 trillion in September of last year when the repo trouble started. So it's doubled. And I expect it to be up to 10 trillion very soon, before the end of the spring next year, I would say. And if they don't do that, you could see a lot of things unraveling, in my opinion. So let's go through this article here in the FT. It says, a sell-off in U.S. government bonds regained momentum at the end of the week, pushing the 10-year Treasury yield back to a 4-month high of 0.85% on Friday, while we closed around 0.88. Back on the 21st of October, when I made my video warning about the Treasury market and yields rising, I think we're starting to break the 0.8%, which was a key level of resistance. A bout of selling in the previous session had put a month-long slide in prices back in motion after a mini rally in treasuries sparked by the worsening pandemic. The turnaround reignited a question that has gripped investors as the US election looms and the virus cases have surged. Just how far can treasury prices fall after a momentous rally this year? So, as I said, I think volatility is even more important. And usually, of course, volatility in treasuries picks up as the yields rise and as prices drop, prices of treasuries, of course. You need to understand that the price of treasuries is inversely related to the yield. So rising yields, not good for treasuries. That means prices falling and volatility going up. The shift out of treasuries in recent weeks has been fueled by the rising prospect of a so-called blue wave at next week's US election, a scenario where the Democratic Party wins the presidency and both houses of Congress. Some investors have placed bets that the bigger fiscal stimulus expected under a Biden administration would mean a stronger recovery, pushing up inflation expectations and forcing bond yields higher. So what do I think about that theory? It's partly true, I guess, but the other thing is if Biden wins, I think he will be more dovish towards the Chinese. The Chinese might start buying back some of their treasuries that they've sold in the last 12 to 18 months. I think they've sold over 200 billion of treasuries. So that's not very clear, I don't think. And I would also say that a Trump victory would mean a more hawkish stance towards China. And that would be a danger to the bond market as well, because the Chinese might threaten with selling more treasuries. So let's continue. The yield on the 10-year note is once again near the top end of the range in which it has traded since late March, having risen a 0.17 percentage points this month. Thursday's bout of selling was enough to kick Treasury volatility to its highest level since June, according to ICE Data Services. So this is fairly significant as well, because we've seen as well that we've had the worst week and month in terms of performance for the Dow. And despite that, yields have risen. Usually it's the other way around. Yields usually drop for treasuries when there's trouble in the stock market. People go to the safety of treasuries. Let's continue though. But managers are wary of predicting a bigger slump in prices or higher yields. The market has had a pretty big sell-off and it could go further, but I think it will be misguided, said Robert Tipp, chief investment strategist at PGIM Fixed Income. In 12 to 24 months, we will still be working to revive the economy, not dealing with an overheating. According to modeling conducted by Gregory Datko at Oxford Economics, a Biden stimulus package could help fuel a roughly 5% inflation-adjusted expansion in the U.S. economy next year. I'm not too sure about that, because it seems like Biden wants to lock down the economy, just like they're doing here in Europe. A continuation of the status quo in Washington would see real GDP rise 3.7% in 2021, while a Republican sweep would deliver growth of about 2%. Dan Iverson, Group Chief Investment Officer at investment firm PIMCO, which manages $2 trillion in assets, says the 10-year yield could top out at 1.25%, still some way below the 1.9% level where it started the year. Any type of contested election scenario or a material deterioration in virus containment and the resulting further shutdown of segments of the global economy can absolutely lead to a meaningful rally in treasury bonds, he said. And this is the part where it shows that these fund managers are comfortable with holding treasuries just because of the Federal Reserve put, so to speak. It says any sharp climb in yields would crash up against the Federal Reserve. Fund managers say, having taken unprecedented action this year to stave off a much more pronounced financial crisis, the central bank is unlikely to tolerate a destabilizing rise in corporate borrowing costs. Why would corporate borrowing costs rise? Well, as I said, a lot of corporate borrowing costs are based on the benchmark Treasury yields, especially the 10-year yields. I don't think we have to fear a bear market in U.S. government bonds that gets out of hand. Famous last words? Who knows? Said Alessio DeLonges, a senior portfolio manager at Invesco. The role of the Fed and the amount of support for the bond market that is coming from quantitative easing is very, very powerful. So there you go. The Fed, unless it's going to let everything hit the fan, the Fed is going to be obliging with trillions upon trillions in the next 12 months. I think it could be up to 5 trillion or even more. We could see that balance sheet zoom right through 10 trillion very easily. We could see it double to probably 14 trillion, I would say. And what would that mean for precious metals and commodities? Well, it would mean a massive boost to those markets. And I'm not too sure the Fed will stay in control of the bond markets, even if it creates all these trillions of reserves, because investors are going to be spooked by rising commodity prices and rising precious metals, which basically means a fall in the fiat currency, in the reserve currency that the dollar is, right? So let's look at the article from the Wall Street Journal, get the view from the other side of the pond, so to speak. U.S. bond yields climb on post-election outlook. Many expect more stimulus and government borrowing after the election. Expectations for a post-election surge in government spending powered the yield on the benchmark 10-year Treasury note to its biggest monthly gain in 2 years on Friday. The 10-year yield, a benchmark for borrowing costs on everything from mortgages to student loans, settled at 0.858, notching its biggest monthly climb since September 2018, according to TradeWeb. Some investors said expectations that post-election economic stimulus will spur growth and inflation, along with greater government borrowing, have spurred the move. Probably true. The other thing I would say, though, is that I think we could see a very uncertain post-election. I think that the demand for treasuries, the safe haven status of treasuries, not just for U.S. investors, but for foreign investors, is related to the fact that we have a stable political system in the U.S., that we have the so-called smooth transition between administrations. And I think this year it could be very different. We could still be seeing a lot of disputes all the way up until January as far as having a winner declared for the presidential election. And I think that could spook investors as well, especially foreigners. Many are now betting on Democratic control of the White House and Congress, which could result in greater spending to help business and local governments weather the pandemic. So we saw the FT talk about this as well. The U.S. Treasury plans to issue trillions of dollars of securities in coming years to fund everything from tax cuts to economic relief efforts, and analysts said it would likely continue raising the sizes of its bond auctions next month during its quarterly refunding announcements. Those wagers have outweighed investors' tendency to shelter in the relative safety of government debt during stocks' recent fall. The S&P 500 posted its worst week since March on Friday. even as the 10-year yield, which rises when bond prices fall, notched a second consecutive weekly gain. It was just the 17th time since 1962 that the 10-year yield increased for the week, while the S&P 500 declined, according to Bespoke Investment Group. So you see, that's the other thing that's very dangerous, because a lot of the algorithmic trading systems, they base their moves for the people who use them on such kinds of statistics. The fact that this is a rarity, that you see treasury yields rising when the stock market is not doing well. As you can see, it was only the 17th time since 1962 that happened. So, and with the leverage that we see in all the markets, and especially bond markets, that could be disastrous in terms of volatility and liquidity as well. You could see investors trying to call primary dealers or dealers to get prices on treasuries and corporate bonds, and they get like a very wide bid and offer. And that's what happened in February and March. And I think that could be a very dangerous situation. Investors will demand higher rates to absorb the supply of debt if the U.S. goes on a massive fiscal expansionary program, said Michael DePass, global head of U.S. Treasury trading at Citadel Securities. I think it's going to happen. It's bound to happen. They will have to increase the fiscal spending. Even the Federal Reserve is being encouraging Congress to come up with more stimulus. The IMF also is behind all that. Expectations that the Federal Reserve will hold interest rates low for years to help boost the economy, along with the central bank's bond purchases, have helped keep treasuries trading in a narrow range for months. A Democratic sweep could upend that range and send 10-year yield back above 1%, many said. The general consensus is that a Democratic sweep will be negative for treasuries given the likelihood of considerable debt finance stimulus, said Russ Kosterick, a portfolio manager at BlackRock Global Allocation Fund. Well, I would say even a Trump victory and possibly, let's say, a red state sweep of the Congress as well would do the same. I don't think the Republicans are any better in terms of not spending. We've seen that under President Trump. We've seen the debts balloon as well. Another reason analysts said bond prices have fallen alongside stocks. Hedge funds are looking to rotate into cash, cutting positions ahead of the U.S. election to avoid price swings. So there you go. So what about precious metals? Gold and silver, I think, gave some good signs yesterday. Not only bullion, but also GDX and GDXJ were up on the day. Have we seen the bottom? Have we seen the end of the consolidation that we've seen for the last few months in precious metals? It's difficult to say, but yesterday's move was very encouraging. While the stock market was floundering, we saw gold and silver actually up substantially on the day. Yes, granted, the Dow rallied 200 points in the last 10 minutes. It did finish down, but not as much as it was earlier. But be as it may, we saw the GDXJ up 1.1% yesterday, and we saw the GDX rise almost 1.5%, and we saw gold and silver hold really well. So I think that was encouraging, and I think no matter what happens, one thing's for sure: the Federal Reserve is going to come out and create trillions more of reserves in order to save the bond market, try to save the bond market, because you never know. We could see investors actually lose confidence, and we could see the Fed have to increase its QE even more. And we could see the dollar get hurt from that. We could see investors losing confidence as well in the dollar, and we could see a big move towards not only precious metals, but the general commodities. As I've said before, general commodities are the most undervalued in terms of GDP since the early 1960s. So I think it's only a matter of time until sentiment shifts. And I think a lot of these bond fund managers are going to be caught wrong-footed. I think volatility also is a big factor here. We start seeing bond markets drop substantially, bond prices. We could see yields start spiking and also dropping at the same time. And we could see liquidity completely dry up and people not be able to liquidate bonds, especially lower rated corporate bonds. People are going to be calling their dealers and they're not going to be picking up the line. So they're going to basically have nothing to show for in terms of cash if they want to get rid of cash. And just before I finish, I'll show you the chart of the 10-year yield. And yes, you might say it's still really low, historically speaking, but that's not the important part here. You need to realize that the volatility is what matters here, because the leverage is so huge that volatility will kill the financial system, just like it almost did back in February and March. As you can see here, this is a daily chart. Look at the ranges we had in the Treasury yield. I mean, I worked in the bond market for over 20 years, especially in Treasuries and other government bonds. And I never saw ranges like this in Treasuries. For example, on the 17th of March, we had a low of around 0.74 and a high of like 1.1 in the 10-year yield. And that's unheard of. And that's what could really set the Fed off into trillions and trillions more of printing in order to save not just the Treasury market, but all the other bond markets that are based off Treasuries, and also the stock market, of course, all the other financial markets. So my conclusion is that things are very uncertain, and we need to keep a very close eye on Treasury yields. If you've been listening to my videos for the last few years, there's nothing for you to be concerned about. If you've done what I've been trying to do personally for years, and that is get out of the system as much as possible, the financial system, the banking system. If you've been able to also, or tried to stack precious metals outside the system, physical gold and silver, you have nothing to worry about. And if you've also been trying to pay off debt, of course. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great weekend. Take care. Bye.